Will the Fed raise rates 25 basis points in June 2026? IBKR prediction markets let you trade the outcome alongside your stocks and options. Earn interest, get it right, and earn $1 per contract at ibkr.com/predictions. Last trading day, June 17th.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome into the Chit Chat Stocks podcast, a podcast to help you find your next great investment. My name is Brett Schaefer, and I'm joined by my co-host, Ryan Henderson. Today, we bring on new guest, Rupert Mitchell, author of the Blind Squirrel Macro Substack, a Substack helping uncover macro for civilians. Ryan and I are two macro civilians, and I think plenty of the listeners are as well. So I'm really excited to talk today, just as a tease for the audience to help them know what this episode is about. We're going to start with Rupert's background, hit a lot of the SpaceX IPO because Rupert does have some expertise in how all this process works, and then go through the entire capital raising market and how it's affecting the hyperscalers, the giant companies, and really the market in general. So let's get into it. Rupert, give us a brief background on your career and why you decided to start the Blind Squirrel.
Oh, wow. Well, I spent 25 years on the sell side starting in the early 90s. And most of that time was as an equity capital markets banker. And I spent, the last 10 years of my career in Asia for Goldman and Citi running Asian equity capital markets businesses for them. I moved down to Australia 4 years ago, which is when I started Blind Squirrel Macro. I fell in love with a Melbourne girl and moved down here. So yeah, that's where we are, and that's hence my my close interest in what's going on with all these jumbo IPOs, because they're pretty unprecedented.
We're going to talk about some of the big IPOs and the big prospective IPOs going on right now, but Rupert, before we hit record, you mentioned that you you were used to seeing $50 million as a big figure back in the day. Does it feel like people have just become desensitized to how large?
It's something I think about a huge amount. I mean, the law of large numbers has got us all insensitized to reality somehow. When I first started, a $50 million equity fundraising was a decent meal ticket for an investment banker. Nowadays, that's like a sort of half a day's ATM for a decent sized company. No, I think the numbers have got completely out of whack, and sometimes you just have to pinch yourself when this isn't central banks moving digits from one side of the ledger to another. When you're talking about risk capital in an IPO, that stock's got to find a new home, and people aren't unloading money market funds to buy these stocks. They've got to offload other risk assets to make room for these things in their portfolio, and I think that's a really important thing to think about.
Okay, let's dig into, I guess, what seems like has been the biggest headline of the last month or even longer, which is the SpaceX IPO. I guess to kick things off, are you surprised as we're talking today? And granted, it's moving around a lot every day, but it's still sitting around a $2 trillion market cap. Are you surprised that the IPO got out so clean?
Listen, I think hats off to the bank team that put that deal together. I think it was, it surprised me how smoothly it went. They'd clearly lined up demand, and they couldn't out of the gates rely on the passive demand or even, hedge funds bridging to that passive demand. They got whether it was the existing cap table or new people to show up. And, they had to raise $86 billion, including the green shoe, and they did that incredibly smoothly. Traded very well out of the gate, but, I don't know whether it was the bond deal that spooked things this week. But that there's clearly now a lot more focused on just how much more of this paper comes into the market. I don't know to what extent you've looked at the lockup schedule for SpaceX, but you've got consistently, starting from August, you've got another $170 billion of supply coming, and then literally it's 60 billion a month, right? These are huge numbers, and then come November, the free floaters is 8 times what it is currently in terms of share count.
Yeah, maybe we can skip to that question now. Take us through exactly how you think the lockup period could materialize for SpaceX, and is it different than typical lockup periods? Because really, from our perspective, someone who we just buy and sell individual stocks, a lot of our listeners do as well. We just understand that there is a lockup period, and it's usually like 90 or 180 days after.
Yeah, a typical IPO lockup is 6 months, 180 days. What they've got here is a staggered lockup, whereby there's a drip of that basically come the 2 days after the Q2 earnings, which is probably going to be the 10th or 11th of August. You've got an additional $900 million shares of supply, 912 million shares of supply. That's 150% of the stock that's already out there in the market, right? That gets topped up by a further 455 million shares if SpaceX's share price is 30% above IPO price of 135, right? So the test there is 175.50. So at that point, you've already at that point that's triggered. You've already got 3 times the free float that the company started with the week before last, right? Then it's not even 10 days later, you got another 319 million shares, another 360 million shares in September, and then some more in October, and then come Q3 earnings, that's so expect that sort of first week of November. You've got another 1.3 billion shares of supply. So, I mean, you are literally looking between now and November at just a staggering amount of paper that's got to find a new home. Now, sure, there is, there's index demand from the MSCI, NASDAQ 100 and Russell benchmarked sort of passive and closet benchmarkers. But, that is not a massive number compared to the amount of passive money that is tied to the S&P. SpaceX won't get into the S&P until it's at least done 12 months of seasoning and satisfied profitability tests. That by my calculations is worth about $19 billion of potential demand. But in the context of this free float, it's really not that much.
Yeah, I mean, you have such a large market cap. I saw, and one of our listeners said that wasn't really the right way to look at it, but I saw that the IPO was 4 times oversubscribed. I don't necessarily know what that means, besides that a lot of people wanted to get in on the IPO. Maybe, correct me if I'm wrong here, but they have the ability or the need to raise more fundraising or to raise more money. Excuse me, I'm saying that weirdly. Would that indicate that there's demand out there to buy more SpaceX, bonds, whatever they're doing the capital raise this week, or am I looking at that incorrectly?
Well, I mean, first of all, debt markets and equity markets are different funding sources. The fact that they came to the bond market to refinance the pre-IPO bridge so soon, I think surprised a little bit. It's sort of yet more demands on liquidity, but they are different markets. And you're right to raise the fact that SpaceX itself is burning a lot of cash right now on a quarterly basis, or at least the XAI component of it is. I have no doubt that they're going to be back in the market for primary equity pretty soon. And you've seen how the other hyperscalers are behaving. I mean, we had that $85 billion raise from Google. Meta's been mentioning that it might tap equity. Is Microsoft behind that? And then we can go on and talk about that. But I think that the whole dynamic about how, the key constructs of the US equity market over the last 10 to 15 years is really slightly going into reverse. I've coined this phrase that the age of reverse de-equitization is upon us. And perhaps we can talk about that in a second.
Yeah, we can definitely get into that. The one, maybe I'm looking again at this incorrectly, but there's been the rise of these at the money offerings. At least from my perspective, they've become more popular. What would stop a company like SpaceX? They're trading at, say, roughly 100 times sales for, still pretty extreme and an absolutely extreme valuation. What's stopping them from doing an at the money offering for $100 billion and just getting as much money raised as they absolutely can?
I mean, they're locked up currently,
Okay.
right, per the terms of the underwriting agreement. But that can be waived by Goldman Sachs and Morgan Stanley if they see demand, and if the company needs the money. I mean, I think they would be mindful of just how much secondary stock needs to be absorbed over the course of the next 6 to 9 months. Pouring primary on top of that, unless they badly need it, would seem like a fairly dangerous thing to try.
All right, or Ryan, go ahead.
Yeah, I just and you mentioned the Alphabet capital raise, which we can talk about in a second. But I guess my question would be: you talked about the lockup, and you talked about all the shares that would become available for sale. I mean, they had a ton of private rounds. I think they had a Series N, which might be the furthest I've ever seen. How would shares? Maybe this is a dumb question. How would shares not go down after how would the share price not go down after the lockup? With all,
well, I mean, just because they're unlocked doesn't mean they have to sell. But ultimately, right, if you're a venture capital fund or private equity fund, this is a big realization opportunity. They kind of have an obligation to, in most of these portfolios, this will be their most successful investment on paper in the context of a pretty tough few years for the venture world. What may happen is they may give their LPs the opportunity to just take the SpaceX stock in specie. There are a lot of believers still out there, so that stock might not touch the market directly. But I think net, you're going to have to see a decent amount of supply coming to the market.
Now, what did you think about the indices? I know S&P is the biggest player in that room. And then there's QQQ that decided to accelerate, including them. What were your thoughts on that? Kind of just in general, like good, bad. Was there anything?
Listen, I don't think it's a positive development for the market at all. Right? If you look at the S&P right now, 51% of the S&P by market cap, by index composition, is trading at above 10 times sales right now. Right. And the number, I haven't run the numbers for the triple Qs, but that's going to be much higher for the triple Qs, just given its sort of tech composition. And that's before you add SpaceX and possibly OpenAI and Anthropic. So when you've got a major benchmark index that's trading at such a rich valuation, what are your expected forward returns there? That would be my concern. Right. And, so much sort of unconscious money drips into these benchmarked indices every month with 401k flows. You multiply that against expected returns. That's a concern.
Yeah. I mean, you look at potentially the incentives from someone like Musk, someone like Altman, the team at Anthropic to try to include it in there. Is that too
I'm
I mean,
sure
maybe
there
I'm
was
looking at it cynically. Is it to support their valuations, to try to just get some sort of liquidity in there? Like, I feel like I'm looking at it extremely cynically, where they want
I
retail
don't
and
think this.
passive flows.
I don't think the cynicism is misplaced, and frankly, the likes of Musk, Altman, and Amadeo be doing their fiduciary jobs to their existing shareholders to try and maximize potential demand for their deals, which, being part of the index, clearly delivers, right? But you know, ultimately, if you're gonna cast any criticism, it has to be at the index compilers rather than the companies trying to improve the lot for their existing shareholders, right?
Yeah, makes sense. Makes sense. All right, let's move on to the big thesis you have on the wider capital raises from these hyperscalers. We saw, I believe, it was roughly $80 billion from
Yeah, it was
Alphabet.
85. They upsized it slightly, right?
Wow. All right. I
Yeah.
mean, that kind of leads into my question here. How much dry powder, that could be the wrong word here, is there to soak up demand from big tech? Like, could they issue a trillion? Like, is there enough demand for that?
I don't know where enough becomes too much, right? No one will be able to give you that number with any degree of precision. I think what's more interesting is if you look at just how, you know, if you look at the way in which the Mag 7 or the original FANGs have outperformed the broader markets over the last 10 to 15 years. I mean, the triple Qs, right, the Nasdaq 100 has outperformed the equal weight S&P by a factor of 4 times since the mid 20 teens, right? Um, I I have a theory that a lot of that outperformance is due to simply the amount of stock that companies like Apple, like Microsoft, like Oracle, like Google were buying back from the market, right? Billions of dollars a quarter in terms of buybacks, right? You then look at the other supporting structure of of the market of the last 10 to 15 years, which has just been there's only been one trade. So the inflows, both from domestic 401ks and foreign capital coming into the market, has just been a sort of a one-way bet in terms of flows, right? And then on top of that, for a lot of the last 10 to 15 years, you had a constant reduction of share supply in the US equity markets, just with the growth of the private equity industry, companies getting taken out. Now, the private equity industry is a different topic for another day, but clearly they're looking at lean times in terms of returns and in terms of realizations to their LPs. You then look at the whole AI capex boom, and the wonderful thing about the US tech dream story over the last 15 years is that these amazing asset light tech companies were generating gobs of free cash flow, which they were redirecting to shrink their share count, a massive sort of pillar, if you like, behind performance of that market. They're now spending trillions of dollars a year on GPUs and data centers, right? They don't have that money for the buyback, so that's gone, right? These GPUs and data centers are doing well, if you're to believe some, a pretty good job at reducing white collar jobs out there. Where does the 401k flow money come from once that's happened? Now, I naively thought until quite recently that there would be there's the internal free cash flow generation, and then there would be capacity within the debt capital markets that would support this build out. But it's looking to me like they're beginning to tap out the capacity of the debt markets. The top hyperscalers and the neo clouds, if you look at their on and off balance sheet liabilities to the public and private debt markets, they total just under $2 trillion right now. Right, they're crowding out the debt markets, and that raise by Alphabet announced a couple of weeks ago, I think is a sign that the dam's breaking in terms of primary equity supply from the hyperscalers to support this capex, and they don't show any signs of slowing down or stopping yet. So, I think that totally upsets the equilibrium that supported equity markets in or US equities over the last 10 to 15 years. And I wouldn't be remotely surprised to see, some kind of mean reversion whereby the forgotten 490 starts to significantly outperform the headline triple Qs, right? Just as hyperscaler equity supply, you know, for puts a lid on what those big stocks can do.
What did you think about the timing of Alphabet's capital raise here? Was this do you think they were trying to get in front of the SpaceX IPO and these other potential IPOs?
Listen, there was clearly a huge amount of, exuberance and excitement and demand for paper out there. So, as a capital markets banker for 25 years, I'd always used to tell issuers, you raise money when you can, not when you need, right? So I think it makes perfect tactical and strategic sense to get out in front of the pack, right? So, kudos to them for doing it. And just to be clear, not all of that 85 billion has been raised yet. I think it was 40 billion of the total is coming in the form of an at the market offering. So that's being tapped right now. And I think, I don't know if they're doing it yet. I haven't checked the disclosures, but ultimately Google's been trading pretty soft since the deal. I wouldn't be surprised if they started and then stopped.
Will the Fed raise rates 25 basis points in June 2026? At IBKR prediction markets, the yes recently traded at 5 cents, while the no traded at 90 cents, but the markets can change quickly. Trade prediction markets on political, climate, and economic events with simple yes or no prediction style contracts where prices reflect probability. Explore trending data, spot the trends, and if you get your prediction right, you earn $1 per contract at settlement. Plus, you'll earn a 3.14% APY on your investment with an interest-like incentive coupon, and you'll get $3 for signing up with IBKR prediction markets, which you can use for any purpose or to start trading. Prediction contracts are not suitable for all investors. Go to ibkr.com/predictions and turn your views into IBKR prediction contracts today. Last trading day for this contract is June 17th.
I look at something like Palantir, I guess, is something I use as a proxy for one of the, not necessarily, it's not one of the giant technology companies, but like risk on versus risk off. Almost the same, for at least for me, for something like Bitcoin, where, all right, when animal spirits are high, people love something like Palantir. They have it the last few years. And I've seen the stock down 30% year to date. Would something along those lines, and there could be other correlations out there, would that be an indicator to you if this continues with stuff like Palantir continuing to bleed, Google continuing to bleed, that your thesis is correct? Is that what, listeners should look out for, that, all right, we might be finally seeing this rotation?
Listen, I think that there is a massive cohort of momentum investors, particularly amongst retail investors, not just in the US, but East Asian retail is doing a lot of heavy lifting in
Yeah,
US.
the stories in South Korea and Taiwan are crazy.
I know, it's wild, and it's your stocks as well as as well as their own stocks that they're bidding up. Momentum investors back the fastest horse that's running at a given time. And, I think there was a perception, rightly or wrongly, that mantle was going to be handed over to SpaceX. And, yes, the bleed in Palantir started earlier, but I think that's because, the momentum investors were chasing Micron. They were chasing the DRAMs. They were chasing, the massive outperformers in the year-to-date bull run. So, that crowd is always going to run for the fastest horse, right?
Should it, if you were running the finance department or running any of these big tech companies, would you just have an ATM offering outstanding at any given moment? Like, why aren't some of assuming that the big tech companies are still trying to raise money, which it seems like they are, why wouldn't they have an at the money available or at the market?
I think you're going to start to see it. I really do think you're going to start to see it. I mean, the ultimately these guys still have organic cash flows themselves, but they're and they've got stage payments. They don't have to buy an entire data center or pay for an entire data center up front. And while the market's performing well, while the liquidity's there, ATMs are something that they can put off pretty straightforwardly. But this is a pretty major shift in their muscle memory from the last 10 to 15 years. They're more used to running multi-billion-dollar buyback programs every quarter.
All right, should we talk about the OpenAI and Anthropic IPOs? They're supposed to be later this year, rumored to have it. What are your predictions for these? You have a lot of experience of bringing companies public. Where could the problems arise? What would their strategy be? How much could they raise? Could they do even more than SpaceX? What are your thoughts in general?
Well, I mean, listen, all of the valuations are wild at the moment, and I'm really not sure. Just in this, listen, the rocket ship and satellite part of SpaceX is relatively straightforward to value, right? Starlink is a number of subscribers times ARPU business, right? The launch business is straightforward. How many third-party pounds of material are you putting into space, and what are you charging for it? How you value the opportunity in enterprise AI with that ridiculous $25 trillion TAM, I don't know, right? Ultimately, the number on the sheet for XAI is bigger than both Anthropic and AI. The numbers being floated around arrays for both of them is around $40 to $50 billion each, so smaller than the SpaceX deal on paper. My sense is their ability to raise that number is going to be a function of how well SpaceX is trading through the summer, right? There's going to be plenty of rallying around the flag amongst the deep pockets within Silicon Valley to make sure there are a lot of people whose incentives are aligned with these businesses getting public.
Just listen to the All In Pod for some very unbiased commentary on that one.
I have to employ a stunt double to watch the All In Pod for me. I can't quite cope with the wall-to-wall cheerleading. But, listen, you've got to be very careful who you listen to around these transactions. Everyone is long up to the gills in this paper from a much lower valuation than they're going to be talking about when it comes to the IPO. So, make sure that you've got your ears open to independent voices around these topics is what I would say.
So this is kind of a long-winded question, but when I look at these periods of history where there have been massive IPOs, usually it's when times are really good. And like you said, you raise money when you can, not when you need it. In your experience, is it, even if the stock is going to have a rough couple of years after the IPO, is it best for those businesses long term to just get out into the public?
I mean, listen, I think so many of these businesses have stayed in the private markets for way too long, right? The IPO business was not designed to absorb multi-trillion-dollar companies, right? And the opportunity facing new issue investors that are buying the SpaceXs, the Anthropics, and the OpenAIs for the first time at these numbers, is not the same as the opportunity being offered, part of the Amazon deal, 26 years ago, right? You could have a healthy debate about, whether you should expand the total addressable market for Amazon in 1999 beyond books, right? And obviously it's a completely different looking business today. But those IPO investors back then were genuinely getting into a growth story on the ground floor, right? In order to believe that you're getting that kind of opportunity with these IPOs, you've really got to do some spectacular mental gymnastics to get to these $25 trillion TAMs, for example, right? And particularly, when, the return on invested capital around the whole AI build, is coming into some pretty intense scrutiny right now. There's a lot of just believe me, dude, right? Which, I mean, listen, I'm sure we're all super users. I mean, you work at an AI company, Ryan. I mean, listen, we're all big users of the product. We know that we're consuming this product at less than its cost of production generally, right? And maybe I'll pay up, right? Maybe I'll pay up. I'm not sure if someone shows me my real Perplexity bill, my real Gemini bill, my real Manus bill, right? I think I'm gonna have to. I think I'm gonna have to cut off a few subscriptions, right? And enterprises are already questioning some of their token spend, right? You saw the Uber story, you saw the Zillow story. There's a real affordability issue when it comes to some of this stuff. And then you've got the competition from maybe not as good as the frontier models, but you've got the competition from the open source offerings out there, whether Chinese or otherwise. And are people not going to just make do with a slightly inferior product at a fraction of the cost? I mean, so all of these are massive question marks over that $25 trillion number that's being bandied about.
Okay, I think that connects a lot of things together in regards to, the SpaceX IPO coming public. You have all the hyperscalers trying to raise money. It comes down to, at least if we're looking at where the index, or especially with all, the index being pretty much populated now almost entirely or close to maybe half, these being pure AI companies or AI related companies. If we're looking at the S&P 500, it really comes down to, at the end of the day, what the ROI is going to be on all this AI investment, if the boom is real or if it turns into a bubble. And for, as you mentioned, SpaceX this summer, that is maybe going to be the barometer of if the fundraising can continue. Am I off base on that? Is that how you're looking at things, or is it different?
Listen, I am focused first, second, third on this supply issue getting solved. And by the way, it's not just the S&P. If you break down the Russell and look what's contributing to the performance of the Russell recently, that's an AI story as well. Smaller picks and shovel plays in the mid cap index is really what's been driving performance there so far this year. So the bigger meta, not related to Facebook, issue on this front is the US economy is highly financialized, right? And if this flywheel starts to sort of sputter out and not work anymore, I think that feeds into the real economy quite quickly, right? The top of the K-shaped consumer, right? What is where does his propensity to consume? I would say that a lot of his propensity to consume is, the value of his securities holdings, right? When he's making a lot of money in the market, he's probably buying an extra car, right? And so
or World Cup tickets.
Or World Cup tickets, right? Exactly. So I think that, pretty soon a market problem could become an economic problem, is what I'm saying here. Now, there's no doubt that the the real economy is benefiting from, at least in a concentrated manner, but is benefiting from all of this hyperscaler capex. Data centers are getting built. Grid capacity is being built, power capacity is being built. This all creates economic growth. But that capex, starts and stops on the whims of a few billionaires, right? So it's potentially quite fragile.
I have a follow-up here to connect it back to what, our listeners, I think mainly are individual investors, but I have one quick question that I think you're one of the few people that could answer this. How exactly is the addressable market come up with for the S1? Like, do the investment bankers just put a number on a page? What's going on here? Because I always see numbers that get tossed around as, potentially being ridiculous.
Well, typically, I mean, the rules around this have clearly got a lot looser than they used to be because, those kind of statements didn't exist in, prospectuses of 10, 15 years ago, that's for certain. But typically, you require some third-party validation of addressable market data that goes into a prospectus or an S1. And so, for something like this, it would be a McKinsey study or a Forrester or a Nielsen report or something like that. I think that the sourced consultancy that was used in the SpaceX prospectus was some consultancy based in the Gulf, right? That I'd certainly never heard of. But it's an extraordinary source for the largest capital raising that's ever happened on the planet, and supporting such a critical number, right? Because if you like, that enterprise AI TAM is the only thing that's supporting the number, right? Because as I mentioned before, the Starlink and launch businesses of SpaceX are pretty straightforward to value, right? Twitter's got an advertising revenue line, which pretty easy to put numbers around that. Really, everything is supported by Grok becoming a frontier model and delivering return on investment. What's interesting is that I thought earlier in the year that the data centers in space thing was going to be the big MacGuffin that everyone was going to have to clamber aboard. But I think that was sort of dropped as the thing to pin the valuation on, because ultimately, a space data center is still a gigawatt times rental rate business. It's something that can spreadsheet, right? And Musk needed something that you couldn't spreadsheet, right? And so that's why I went. And then that sort of slightly sort of curious pivot immediately ahead of the IPO, where they subleased Colossus to Anthropic to show some nearer term EBITDA for the existing terrestrial data center capacity. There's a lot of smoke and mirrors going on here, but ultimately I think that they pivoted away from a physical infrastructure side to the sort of big story, because it's too easy to put into a spreadsheet and go, yeah, that doesn't math, right?
Yeah, it's the mystery of possibilities is what seems
Well,
to just
it's like full self-driving for Tesla was, right? At the end of the day, when you're talking about your car as an asset that can go out and earn a living for itself while you're asleep in bed, the total addressable market for the mobility business is trillions of dollars. This is going to replace taxis in every part of the world. That's how you have to lean on to something that you can't really model beyond a really superficial market share of an enormous total addressable market.
Yeah, that's a great connection to remind just kind of an old Musk promotional play, the full self-driving. For any listener who doesn't know, it was kind of a 2-3 years down the line, I think we're going to have a massive explosion in revenue from this, and it's kind of just been a 10 to 20 year project. With the data centers in space, I'm seeing similar stuff from Musk. 2 to 3 years, we're going to have this up and running. And we're going to have a revenue of $1 trillion by 2030, possibly. But it could also be the same scenario where instead of 2, it takes 20 years, and that, who knows what that does to the stock.
Yeah. I mean, it's the classic sort of nebulous goalpost shift, right? And it's worked very well for him. Listen, let's be very clear. The man is the greatest ever stock promoter in the modern age. I mean, probably the greatest since, John Law and the Mississippi Company. And, what he's done over the last 25 years is ride the zero interest rate policy bubble to perfection by taking gobs of cheap capital and to heavy industries, automotive and aerospace and defense, right? It was a bold, if you like, gangster move, right? But there are, to my mind, there are limits on how you can value the current Muskonomy.
Shifting gears a bit, I guess I have a question on just some of the mechanics behind an IPO. I'm curious. So we were talking about the TAM numbers and I guess some of the fluff, if you'll call it that, in these S1s. Is that all generated by the investment banks themselves, or is that like usually the company going hand in hand with the investment banks?
So if you think about who's on the deal team, you've got hundreds of corporate attorneys, you've got the accounting teams, you've got the investment banking teams, you've got the business development teams within the company that's going public. The prospectus or the S1 is a joint endeavor between those 4 parties. They will go to external consultants to validate, to provide sort of data to support, the backdrop to the market. So, that's where the report that supported the TAM came from. But ultimately, all of the professional services firms and the company needs to sign off on the document, right? And obviously, everything's disclaimed away. You've got 30, 40 pages of risk factors. People have got so used to seeing terrifying risk factors that they've actually started to completely ignore them. When I first wrote IPO prospectuses, there might be 2 to 3 pages of well thought through, risks facing the company. It's now got out of control, and it makes for very sort of cheap shot stories for journalists. Because they love the alarmist terms in which the corporate attorneys phrase these risks, and it makes for good copy. But ultimately, most investors aren't reading them.
Yeah, I like the classic. If there's a cyber attack, our whole business could crumble. And it's like, well, yeah, thanks, guys.
Cool. Meteor strikes, not good, right?
Yeah,
Not good for satellites.
Exactly. All right.
Yeah.
You have a lot of experience with taking companies public, looking at this general part of the market. I think I have a 2-part question to help, again, our listeners like Ryan and I that are individual investors trying to navigate this AI boom. How do you personally manage during kind of a bull market potential bubble cycle? And what does this period remind you of historically? Because I think, given how you're talking today, you're a bit of a market historian.
So I was very much part of the original sort of .com capital raising boom in the late 90s, right? At the time I was working for Salomon on the tail end of the fiber altnet and actually original round of data center booms. I was involved in taking Asia Global Crossing public. It was one of the last deals to get out before that market blew off. It feels a lot similar. But the trouble with these things is you need to know whether you are in whether you're in 98 or late 99, right? And it's the same in all of these things. Everybody thinks they're going to be smart enough to hit the exit door at the top. That's never how it works. And there are people being sucked late into this trade to this day, right? You're seeing these stories of Taiwanese and Korean retail investors remortgaging their house to buy DRAM stocks when they've just doubled, right? In a matter of the last few months. And every bull market sucks in the late players. And the leverage that is in these that's in these investor classes, whether it's sort of 2x, 3x ETFs or levered into call options, low delta call options, that's a lot of dry tinder on the ground. When this thing unwinds, it's going to unwind exceptionally violently. And the trouble is, if your net liquidation value in your brokerage account, drops by 20% overnight, right? The right thing to do is to take that residual 80% and thank yourself lucky you got hit by your trailing stop and you hold on to most of your capital. It's going to feel like the hardest thing in the world to do, right? And so, from my personal perspective, I've completely missed the memory boom this year. I have some personal PTSD associated with the sector. Funnily enough, when I was in Asia in the early 2000s, I was the investment banker that refinanced out of bankruptcy the original Hynix twice within the space of 2 years. There are a lot of people saying these guys are growing earnings so aggressively, they still look so cheap. All I would say is that unless finance and cycles have broken completely, there is never such thing as a value play in semiconductors. Semiconductors are the most brutally cyclical businesses, and particularly the memory sector.
I feel like if it's trading at 4 times earnings, that's when you go, all right, that's the alarm bell.
Listen, it's the same with all deep cyclicals. They always look cheap at the top. Always.
Okay, I think we're going to start to wrap things up here. So, last question would be, what do retail investors most misunderstand about the IPO process or just about companies raising capital in general?
I think that IPO stock for retail investors over history has been deemed like a forbidden fruit that really only the big boys got to get hold of. And it is true, right? For most of my career, putting more than 5% of an IPO into retail was considered a pretty risky thing to do. And let me be very clear, retail, as defined in those deals, were the uber wealthy clients of the Goldman Sachses and Morgan Stanleys and Merrill Lynch's of this world. This was not, Joe Sixpack with his Schwab account or his Robinhood account. And now we're seeing, in this epoch, you're seeing these unbelievably expensive and potentially very risky investors being offered in huge size to retail. And so the forbidden fruit has become an all-you-can-eat buffet. And the question is, what kind of indigestion are you going to be dealing with this stock? I mean, pretty much anyone that bought SpaceX stock, in the initial pop, well, at least until today, was underwater, right? Most of the experiences recently with IPOs where retail has been allowed to participate in size, have not been great. The hit rate has really not been great.
All right, let's wrap things up here. Before we get out of here, again, thank you for taking the time today. Tell the listeners about what you cover at Blind Squirrel Macro and what type of investor should subscribe.
So, You can find my work at blindsquirrelmacro.com. I'm on Twitter at Squirrel Macro. But essentially, I'm an unashamed generalist. I write about equities, credit, rates, currencies, commodities. I've got experience working in markets all around the world. I write about whatever interests me, and I write about what I'm actually investing in myself. I eat my own cooking. Some of the stuff that some of my investment themes are based around my beta portfolio, which is 70% of what I do, and really that is a single digit vol, beta product, right? Not remotely racy. The other 25% of what I do might be a bit more racy, but ultimately, I just take people along for the ride with what I'm doing, and hopefully amuse them as well along the way. I find markets to be incredibly fun, and I enjoy sharing my passion for them with my readers. So yeah,
And
blindsquirrelmacro.com.
exactly. The link will be in the show notes. The passion came out in this interview as well. We had some technical difficulties. I don't know what curse was put on our recording studio today, but thank you for the listeners for joining us. As a disclosure, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan and I or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, and we'll see you next time.